Welcome to the Deep Dive. We are Talk Tickers, and today we're diving into the Q2 2025 earnings call for Charlotte's Web Holdings. That's CWBHF. Our mission here, to cut through the management speak and really pinpoint the key operational and financial signs. Is this company truly turning a corner, or is it still facing significant headwinds?
It's a really interesting one this quarter. Management sounded quite confident, talking about a fundamental shift in their trajectory. But, confidence is one thing. We need to see if the numbers actually back that up.
Absolutely. Let's start right there. Give us the snapshot. How do they do on revenue? And crucially, what happened with profitability?
Okay, so the top line, that was definitely the positive story. Revenue hit $12.8 million. That's a solid beat against consensus, about 15.7% higher, actually. And it represents 4.2% growth year over year. So progress there.
Okay, 4.2% growth. Not earth-shattering, but positive. What about the bottom line? The GAAP EPS?
Yeah, that's where it's less rosy. Based on generally accepted accounting principles, GAAP EPS, they reported a loss of 4 cents per share. The consensus was looking for a loss of 3 cents, so a miss on that front.
Right, so sales ticking up, but still losing more money than expected on paper. That's often the case in turnarounds, isn't it? Did adjusted EBITDA show any improvement, that operational cash burn metric?
You really did, yeah. That's the key improvement story here, I think. Adjusted EBITDA showed a loss of $3.6 million. Now, that's still a loss, obviously, but it's a big improvement from the $5.2 million loss they posted in the same quarter last year. Shows real structural cost discipline taking hold.
Okay, so that combination revenue growth, even if modest, plus much lower operating losses, that probably explains the market reaction, right? Stability, then a bit of an upswing after the call.
Exactly. Investors seem to be recognizing that, the operational engine is running tighter, even if the GAAP number isn't quite there yet.
And management sees this as validation.
They definitely do. They pointed out this is the second quarter in a row with year-over-year revenue growth. They explicitly called it a fundamental inflection point, basically arguing they're past the really tough stabilization phase they've been in since, 2021.
Okay, let's unpack one number that jumped out at me, the gross margin. On the surface, $6 million gross profit, 46.8% margin.
Yeah.
Looks fantastic compared to 21% last year. But there's a catch, isn't there?
Oh, a huge catch. This is absolutely critical context. That 21% margin last year, it was artificially low. It included a massive $3.8 million non-cash inventory provision, a one-time thing.
A write-down, basically.
Exactly. So if you strip that out, their actual underlying gross margin in Q2 2024 was much healthier, closer to 52.2%.
Hang on. So the 36.8% they just reported, while it looks good compared to the headline 21%, it's actually down almost 5.5 percentage points from their clean performance last year.
That's correct, yes.
So why the contraction now if operations are supposedly stabilizing?
Well, they gave 3 main reasons, said they were temporary. First, some startup costs as they brought gummy manufacturing fully in-house. Second, they ran more promotions, like around Memorial Day, to drive sales, which impacts margin. And third, there was a bit of drag, a few hundred basis points, they said, from selling extract at zero margin to their DeFloria joint venture for the clinical trials.
Okay. So they're saying, trust us, this is temporary, margins will get back to the low to mid-50s. Feels like a bit of a leap of faith, unless the cost cuts are real enough to offset that risk.
That's the bet, essentially. The turnaround really hinges on these major cost resets, and the SG&A number shows they're serious. Selling, general, and admin costs down almost 32% year over year to $10.1 million. That's a significant structural reduction.
And a prime example was cutting that MLB deal, right?
Right.
Saved a ton of future cash outlay.
Over $18 million in future payments gone. Painful maybe from a marketing perspective, but absolutely necessary for cash flow discipline. It shows their priorities.
And that discipline feeds into their big 2026 target.
Yes, exactly. They're aiming for $9 million in total annualized run rate cost reductions by then.
$9 million. That's huge. How do they get there?
They broke it down, about $6 million from just general operational efficiencies across the business. And importantly, $3 million specifically from bringing manufacturing in-house, particularly for the gummies.
Okay, that $9 million figure, it's ambitious. Are these real savings or just, cutting things that might hurt growth later?
It seems pretty credible because a chunk of it, that $3 million, is tied directly to that vertical integration project, the Brightside gummy production. That seems tangible. The other $6 million relies on ongoing efficiency gains and locking in the savings from restructuring marketing post-MLB. So yeah, execution is key, but the plan seems grounded.
Let's talk about that Brightside line then. Low-dose THC gummies, now made in-house. That's driving near-term growth and those savings you mentioned.
Seems like it. They reported strong early demand, initial SKUs apparently sold out over Memorial Day. Good product market fit signal.
But what makes Brightside different? It's a crowded market.
It's the tech, they say. Their proprietary time infusion technology. You know how edibles usually take ages to kick in? An hour, sometimes two? It's a major complaint.
Yeah, the waiting game.
Right. CWE claims their tech delivers effects in just 5 to 15 minutes. If that's true and repeatable, it solves the biggest user pain point. Fast, predictable effects. That's a potentially massive edge.
Interesting. And that innovation focus extends beyond THC too, right? They're moving into broader botanicals.
Yeah. They mentioned new CBG gummies for focus and also functional mushroom gummies.
Which has regulatory advantages, presumably.
Exactly. These non-hemp botanicals face fewer hurdles. That opens up easier access to big omni-channel platforms.
Right, like Walmart.com, Amazon, even TikTok Shop and Sarah, which they mentioned. But doesn't that dilute their margins? Direct-to-consumer is usually higher margin.
It's a trade-off. They seem to be prioritizing scale and reach right now over maximizing immediate margin per unit. Getting onto those massive platforms with easier-to-sell products builds volume, lowers customer acquisition costs over time, and establishes them more broadly in wellness, not just CBD. It's like building the distribution pipes now, so when or if CBD regulations become clearer, they can push huge volume through that established network.
Which brings us squarely to regulation. The elephant in the room for this whole sector. What was the tone from management on federal clarity?
Incredibly optimistic, actually. They used phrases like most promising developments in years, specifically talking about movement in Congress towards legislation that would finally give the FDA clear authority to regulate CBD as a dietary supplement and food ingredient.
Okay, so what if that happens, what does it really mean for Charlotte's Web?
Consolidation, pure and simple. It creates a moat based on compliance. If the FDA steps in with clear rules on testing, labeling, manufacturing, all the smaller, perhaps less compliant players who currently make up a big chunk of that, $2.9 billion U.S. market.
Projected to hit $3.8 billion by 2030, yeah.
Right. Those players likely get squeezed out fast. The advantage swings heavily towards established, compliant, scaled companies with robust supply chains, companies like Charlotte's Web. They could grab significant market share relatively quickly.
That's the big picture upside.
Yeah.
But they also have that sort of lottery ticket with the DeFloria Pharma JV, don't they? Any update there?
Yes, they confirmed that JV has entered FDA Phase 2 clinical trials for AJA001. That's the candidate for irritability and autism spectrum disorder. And critically, CWEB holds the exclusive manufacturing rights if it gets commercialized. So if that program hits, it's potentially massive multi-billion-dollar upside, completely separate from the consumer business, real long-term optionality.
Okay, so pulling it all together financially, cost cuts, innovation driving some growth, regulatory hope, and pharma optionality. What's the timeline they're giving for hitting positive cash flow?
The target is to approach positive cash flow sometime in 2026. That relies on hitting sequential growth targets, getting those gross margins back up to the low to mid 50s, and realizing the full $9 million in cost savings.
Do they have the cash to get there?
Management expressed confidence. They ended the quarter with $15.3 million in cash and about $29.4 million in working capital. They called it adequate runway.
Yeah.
But execution in Q3 and Q4 is critical to keeping that 2026 goal credible.
All right, let's shift gears. It's time for our favorite segment. This is not financial advice. We channel our inner hedge fund managers and pitch an outrageous, maybe plausible trade idea based only on what we heard in this call. Disclaimer applies, of course, this is purely analytical entertainment.
Okay, let's do it. The pitch today. Go long CWBHF. That's the U.S. OTC ticker based on a combo of operational conviction and let's call it regulatory time arbitrage.
CWBHF specifically, the OTC listing, known for its, shall we say, volatility.
Exactly. The illiquidity is part of the thesis here. It's thinly traded, so news moves the needle dramatically. Our view is management's aggressive cost-cutting, that $9 million target, plus the margin help from bringing gummy production in-house, that $3 million piece. It substantially de-risks the path to cash flow break-even in 2026. It makes the operational turnaround feel much less speculative, more like a matter of execution. That provides a kind of floor, you see.
Okay, so the operations provide the downside protection, or at least limit it, and the upside comes from
The upside comes from the catalysts hitting that illiquid stock. That's the outrageous bit. Any sudden, concrete, positive news on federal CBD regulation, which seems closer than ever, or even unexpected positive interim data from that DeFloria Phase 2 trial could cause a really violent, outsized, upward move simply because there aren't many shares readily available for sale to absorb a sudden surge in buying interest.
So you're betting that disciplined operations keep it stable-ish, while a political or medical catalyst provides the rocket fuel amplified by the stock's thin trading.
Pretty much. Exploiting the illiquidity for potentially massive, sudden upside, while feeling reasonably comfortable that the operational improvements limit how far it can fall. It's a calculated risk on timing and catalysts.
Okay, so let's wrap this deep dive. Key takeaways. Charlotte's Web is showing consistent, albeit modest, revenue growth now. They've made huge structural cost cuts. That $9 million target is the number to watch. And they're broadening beyond just CBD, with that pharma play adding long-term optionality. The turnaround seems tangible.
It does, and that leads to the crucial question for you, the listener, to track going forward. Given that stock volatility and thin trading, how much more of that $9 million in savings needs to be clearly delivered and visible in the Q3 and Q4 results before the market really starts believing the turnaround story and begins pricing in that potential regulatory upside? That execution quarter over quarter is really the key metric until we get actual clarity from Washington.
That operational proof is everything right now. Great insights. Thanks for joining us on this deep dive. We'll catch you on the next one.